and I'm very pleased to welcome my panelists to the stage. While we encourage you to take your seats, I'm just going to encourage everybody in the room to join the Slido chat as well. I will be coming to you for questions once the panelists have made some opening statements, so please do think on those questions. So please do come here, do join me here. So if we sit William next to myself, then Mario, Pedro, Giovanni, and Debora. That is the order that I will go down originally to take. So first of all, I'm actually going to ask you all to introduce yourself. So we have a little mixture of voices at the beginning to open it up. So please, William, would you start with introducing yourself and also give us a little bit of a flavor of the macro outlook? What I thought was very interesting from what we've just heard was around that monetary policy, fiscal levers, and actually how they can work together, but also what are the risks that we're seeing, especially in this very high inflationary environment. So William, I will start with you, so please do introduce yourselves and then give that little bit of flavor.
Thank you. Good morning. Thanks for the invitation. William de Vilder, Chief Economist of BNP Paribas. Macro analysis has become incredibly complex, sobering, humbling. I think we've, to a certain degree, assisted to a demise of macro, because macroeconomic developments have become very important. What is happening at the individual company level, at the individual household level. The heterogeneity is a very important characteristic of the current cycle. If you look at where the excess savings have been allocated, the distribution consequences of the COVID shock, of inflation, et cetera, where does that leave us today? On the one hand, you have breakfast TV in France that is reporting almost on a daily basis about elevated inflation, but later on in the program, there is talk about airline tickets that are flying out the door, fully booked over the summer, et cetera. I'm just making an observation here. I'm not making any judgment about what's right, what's wrong, but it really shows you how complex it is to make an assessment of what the current situation is and how things will evolve. I think one of the elements that we're seeing is clearly a risk of inflation declining too slowly. That would mean that the current optimism in financial markets about we're getting close to the peak of the deposit rate at the ECB, and we are at the terminal rate at the Federal Reserve. That optimism might be a bit premature to be seen. Another element which is also complex in assessing the outlook for next year, of course, is one of the key elements that we observe and that reminds us of what happened in the past is that admittedly, financial market conditions remain very easy. Amazingly, I would say markets are not pricing in recession risk. Everybody's talking about US recession. Markets are not pricing it. But at the same time, bank lending conditions have tightened very significantly. And in the past, that has always been followed in the US and in the Euro area by a very negative impact on the volume of corporate investments and on the volume of residential construction activity. So we have to keep that in mind. Now, you always have to prepare for the next quote unquote war. So personally, a topic that I'm very interested in is how do we stabilize the business cycle going forward? The ECB, and just a kind of word of recognition and I would say applause, is of course publishing a number of outstanding research papers on a high frequency basis. And one that I thought was particularly interesting in recent past was when the authors demonstrated that the reaction of financial markets during the COVID shock was more outspoken following quantitative easing, because investors had been pushed out of their preferred habitat more than otherwise would have been the case. And this is then causing these big swings in financial markets, hence tying in with what the previous speakers have said this morning. So the question this triggers, of course, is, isn't there a role to play for coordination between monetary and fiscal, which theoretically is something that we learned at school, but there are a long list of I think, factors that make that more complex. But I would still argue that this is a debate that we need to have. And it was quite interesting to listen to the final words of Luis de Guindos, which he kind of flagged like, okay, we may have an issue there, possibly, but at the same time, cooperation, coordination, I think is something that that should be discussed, keeping in mind that we have huge central bank balance sheets, and keeping in mind that we have a huge challenge in bringing that GDP levels back to more sustainable levels, given the prospect of higher real interest rates, given all the financing needs that we are facing. Thank you.
Thank you very much. I think you set out the challenges and also the areas where both the fiscal and monetary policy need to work together and have that coordination. We'll pick up on some of those points in a little bit. For now, Mario Nava, who is the Director General for the European Commission, it'd be interesting to talk a little bit more, hone in on the Europe, as we are looking at European financial integration, and a little bit on the response of the Next Gen EU and how that is developing, putting together a framework for Europe in its policy response, and maybe a little bit about how we are engaging with the fact that European, I just had a look, is around 7% as inflation at the moment.
Thank you very much, Ellie, and thank you everybody for the invitation. Let me take up the challenge of David. When he was on the podium with Luis a minute ago, said, I heard this already, I heard that already, yeah. But how do we do it? So I'll take it up, the reaction of, take it up the challenge of how do we do it. I think if you look at the European reaction to the COVID crisis, you can say that we profoundly changed the way to do it, right? The European reaction to the COVID crisis had got nothing to do with the previous reaction. You could also say we were in a different position. I mean, Christian Swing said it very well. Banks were not the problem, were part of the solution. But this, you know, is a little bit like David is a little bit like James Joyce. If I want to go to Dublin, I wouldn't start from here. I mean, you start where you start from. So we started the COVID crisis. Thanks God, we had the banks very well capitalized, because we have taken the lecture of the previous crisis. But then when we entered, I think we changed profoundly the method. We moved from what you could say some banalization and intergovernative method, where we tried to be good in every single part, to what I would call a community method, where we try to be good leveraging on each other's strength. There's a beautiful article on the FT of yesterday of Martin Sandbu that I'm sure many of you have read. It closes with a quote which you find zillions time on commission papers, but of course on commission papers is less read than on the FT. And the quote is that an economy is more flexible than the sum of its parts. These are the final paragraph of Martin Sandbu. This is what we have been saying for at least the last 3-4 years. And let me elaborate a bit on parts. Parts, we showed the way out of the crisis, that you could interpret it both as sectors, different dynamics. Comes a crisis, some sectors are more affected than others, and we help some sectors to reform, we help some sector to transition, but also in terms of countries. I mean, I think for example, with the migration crisis and with the energy crisis, the type of mutual support that countries gave one another was quite strong. This is key to a central factor, which is resilience. I mean, we put up something called the National Plans for Recovery and Resilience. Well, the European economy has demonstrated a phenomenal resilience in the last 3 years. Everybody was waiting a recession. The recession has not arrived. You have mentioned the inflation. I don't talk about inflation, but look even at the micro episodes. I mean, we have had three financial market episodes in United States, in Switzerland, and in Europe, here in Germany. And I mean, I'm very sorry, but the reaction and the stability that Europe and the European institution, this very own, has demonstrated was much, much superior as a reply to the one we have had in the US and in Switzerland. So I believe that the community method has allowed us to construct a resilience which was very clear. And the third reason, and then I'll stop and maybe we take it up later. But the third reason of, again, the third reply to David's challenge, I believe Europe has been in the last, since 2015, basically. So once we emerged clearly from the euro area crisis, we have been very, very clear on what are our goals. So we didn't micromanage a crisis. We didn't respond at the margin on one or the other thing, but we have been very, very clear on what we want. We want the twin transition. We want a green Europe. We want a digital Europe. And I think we have acquired a humongous credibility on financial markets, but on real markets of the world, when we were able, in front of adversity, to keep those two goals. I mean, let me remind you, the COP decides that we need to make effort to remain under the certain threshold of emissions. Few months later, a new political situation in the United States basically withdraws from the COP. Europe decides to keep strong and to become essentially the leader of the world for the green transition. Then COVID comes. And many people said, well, now, I mean, leave us with this green. We have other more important things to do, right? We have a pandemic. And we said, no, maintaining green and digital, in particular digital, is one of the replies to pandemic. Then the war comes. And people tell us, well, now stop with this green. I mean, there's the war, you know, more important things. And we said, well, actually, the war means an energy crisis. And if you look at the REPowerEU, 2 out of the 3 pillars of the response to the energy crisis are green, renewable sources and saving. So I believe if you put together these 3 elements, a community method, or in journalistic word, an economy is more flexible than the sum of its parts, and then a construction of a resilience that was unseen before, and finally the clarity of goals. If you put the 3 together, I think this is a possible way to go. So a reply to David's challenge.
I like the optimism and the path for the future. I'm very pleased that we have set that out, and I am also pleased that Pedro, who is the advisor for the board of directors and former vice governor of Banco de Portugal, is here as well to elaborate a little further on the conversation around the current macro outlook, but also what does rising rates within the central banking. We've seen rate hikes and also indications that there'll be further rate hikes from both the Fed and the ECB, although possibly at slightly more muted increments. What does that mean for the financial stability? And are you as hopeful as Mario?
Okay, thank you very much. It's really a great privilege to be here. Let me thank the association and OMFIF for this invitation. Being at the central bank, of course, I'm not going to comment at all on monetary policy, and the usual disclaimer applies. Following the intervention of the 2 previous speakers, and let me echo as well, Mario, on the proofs of resilience of Europe over the last 4 or 5 challenging years, I'd like to bring a word of caution on the current situation. And for that, I will focus on 3 macroeconomic variables, either in Europe or around the world. So the first one is unemployment, which is in most advanced economies at the 50 years low. I mean, in Germany, unemployment is 2.8%, in the US 3.4%, in the euro area as a whole 6.5%, which are the lowest values since a long time ago. So this is a measure of the cyclical position of the economy in terms of use of economic resources. The second one is debt. World debt in percentage of GDP, world debt, so that's a global figure, is around 250%. 100% around public debt, 150% private debt. Once again, this is all-time heights that has never been achievable over the last 50 years. This is a measure for the world, so for some advanced economies, this is even higher. And of course, that's very important in a situation where we have inflation and rising interest rates. The third figure is, of course, inflation, which after achieving once again 35 or 40 years high, is now declining some 4 or 5 percentage points below maximum levels. So what does this imply for, policies and economic agents? I'd just like to highlight some important events that basically contribute to the low prospects of growth that have been released by international organizations like the ECB, the IMF, and the like. First, important to remember the sharp duration in terms of trade, which took place in Europe, of around 9–10% over the last 2 years, and that, of course, will have impacts on the euro area economic situation. Second, monetary policy has been very active in the recent past, and that, of course, we know that impacts on real demand take some time to materialize, 2 years, let us say. We are witnessing very different effects across the economies. For instance, in the banking sector, we have noticed, of course, the impact on some banks due to valuations. On the other side, we see some banks gaining through the net income margin. So there are very diversified impacts. No impacts, however, relevant in terms of credit risk. We have seen some stressed sectors on real commercial estate, US once again. And on housing prices, we have seen the first declines in the recent past, both in the US and in around half of EU countries. And of course, we know that housing prices are relevant for the evolution of the economy. And I will not mention here the riskier signs from some segments of the capital market. So concluding implications for policy, I would first ask for some counter-cyclicality, given the cyclical position in terms of use of resources. For instance, in terms of fiscal policy, we notice already the very strong effects on revenues through tax increases. Maybe the effects on expenditure will take more time to materialize, but it's important to assess very well the existing fiscal space. On the side of macroprudential, I think that in some countries where the evolution is stronger, there's still some space for some macroprudential counter-cyclicality. On the side of authorities, we have to be really very alert because events materialize very fast indeed. So to be alert is very important. And on the side of economic agents, I think that all the opportunities to build resilience should be used. Firms increasing efficiency, reducing debt levels, the banking sector possibly increasing management buffers, taking advantage of the effects on margins, and non-banking sector to take special care on liquidity positions. So C for counter-cyclical, A to be alert, build resilience, RE, so care or caution will be my suggestion at this stage.
Thank you. Thank you very much. And we will circle back as well to talk around the structural challenges that Europe and the world is facing, especially in regards to demographics. So I think that is something that I want to definitely build on when we're talking about the building of resilience and the concern around what's coming around the corner. But first, Giovanni, I'm very pleased that you're here to talk around what this means for financial markets. We've heard what this means for policymakers. we've had that quite a lot integrated through this morning. And I'm very pleased that we can now come to you and then also Debora afterwards to talk around what this means for the markets and also then for the real economy. So Giovanni Callegari, who is the head of economic risk analysis at the European Stability Mechanism, I'm sure that looking at the risk analysis has kept you busy over, I don't know, the last few years. So thank you very much for joining us.
Thank you, Ellie. For us, the focus has been really in trying to assess the risk without crying wolf, no? Because there was a big risk since the beginning of the COVID crisis that everything will go very bad, that fragmentation will come big time. But really, the policy response has helped financial market responding and realizing the resilience of the euro area in a whole. A reflection of this in financial market developments that also, to what also Mario was saying, is really the big swap in the determinants of bond market volatility. Up until pre-COVID situation, and very much after the financial crisis, the sovereign crisis, was the spread component, the risk component, the country-specific component that was driving bond market volatility. Now it's the riskless, the risk-free component linked to policy rates, whereas the spread component is much more muted. In some countries, very, very compressed compared to before. This is the result of the policy reaction function. This is the result of also the inflation tailwind. Does this mean that there are no risks going forward? Yeah, not much, unfortunately. There are two words that are keywords that I would like to mention here and propose to you. Is really the first one is transition. We are still in the aftermath of the pandemics, that we are still going through recomposition of production, recomposition of the terms of inflation. The last month, for the first time, the service component of core inflation became more important of the goods component as a symptom of a recomposition of growth. The composition of growth in terms of supply has been changing very much over time. There is really a big risk that this transition becomes inertia. Okay, it becomes inertia, becomes the type of persistence that is bad, that restrict resilience, that does not allow response to shocks. Do we see this in Europe at the moment? No, we don't, because really we have a strong policy response at the ECB that is keeping keep inflation expectation well anchored. And then there is a strong response, there has been a strong response on the banking side that limited the contagion for the two big events, one of Credit Suisse, the other one of the Silicon Valley Bank, and the aftermath happening in the US. So we are stronger, but we need to maintain the policy framework. We need to maintain the capacity of financial markets to see the policy framework evolving in a simple way. And this is a way important to read the interaction between monetary and fiscal policy. We have huge challenges on the financial market side. We will have sovereign issuance increasing this year compared to last year, will continue to increase next year. The cost of issuance are increasing, are almost doubled. They were 1.4% in 2021. They are now 3.3% in OECD countries this year. So the pressure they can put on budgets are relevant. But if we keep expectation on fiscal developments well anchored through a simple set of rules that can be well understood by markets, then we have really this good combination, the continuation of the good combination of both expectation well anchored on monetary policy side and also expectation on sustainability well anchored on the fiscal policy side. It will be challenging. The Commission has been proposing, has been legislative acts, and it's been currently being discussed. I think we are in a good position, a good stage in the discussion, but the simplicity is really important in a situation, an environment of high uncertainty as we are now.
Thank you very much. And I'm pleased to move swiftly to Debora as well to talk around, from Chief Economist in the European Investment Bank. And I want to talk around the outlook for investment landscape and the implications within the real economy. I think it's really excellent that we have had conversations around the policymakers. We've talked around what needs to happen in this capital markets union, but actually let's talk around what is happening in the real economy. There was a mention of house prices and the housing in the landscape as well. So we could perhaps touch on that a little too, if it fits into the real economy narrative. And how.
So thank you very much, and I'm really happy to join this great discussion and come after these super interventions. I will focus on the link of what has been said both on the policy point of view and on the financial market point of view, and what it means for a financial condition and for the real economy. I think my starting point is that this is nothing normal is happening at the moment. So the difficulty is really in a completely abnormal path with a lot of uncertainty to really read the message and read what really means the underlying signal that we see. We see the exit from the pandemic and the war, but that war, and it also means a lot of policy support that is trickling down and going to household, to corporates, and you don't really know what is the self-standing capacity out of the period of very strong support that has been deployed. We see also now the increasing pressure of the globalization, and there is this idea of globalization was bringing a growth dividend at the global level and European level, and we are losing this in the new process if it goes on. And then we see also that all of this is coming after decades of abundant liquidity, and we see the retrenching part. We always say that the retrenching from quantitative easing will be bumpy, and I think we still are in a process in which we know that there will be bumps. We saw something with the Silicon Valley Bank consequences, but we still don't know exactly why, like I was saying before, why we have a solo spread of sovereign in Europe. It's a big question is how do we achieve that? And it's a good news, but it tells you that there is a lot of unexplained. What is clear, and I think it's something that we have very much in our work at the European Investment Bank, is the fact that long term we have a bigger challenge, and that's the structural growth. The potential growth of Europe has always been a concern in the past. A lot of the policy response in the last years and the Recovery and Resilience Facility was really going toward impacting a potential growth. But I think there we really need still to see how much this really will lead to some higher potential growth, which is the bigger question mark going forward. What we see now on the economy, I think the Commission just came out with the forecast, slightly upgrading EU forecast to 1%. I find it optimistic. I don't want to, I think in the uncertainty, the Commission wanted to play the positive notes, saying at the end, with all the uncertainty, what we see in the ground could lead in these big swings to some higher growth, but it's not a complete positive message on economic dynamics. And what we see granular is the effect of world trade volumes that is declining. We also see this very strong decoupling between manufacturing and service sector. Actually, manufacturing data, both in terms of survey, but also real data, started to pricing some kind of recession, while we don't see on the service side. So we have all these contrasting messages coming up on the real economy side. If we go to financing condition, I think we start seeing some tightening of financing condition. It took time until the financing condition started the tightening, and that's also something peculiar. We had the first phase of rising rate was really coming with no tightening of financing condition in the markets at all. We have seen a little bit of bumps, but immediately contained following the Silicon Valley Bank. And what I was mentioning before, in terms of sovereign spreads, we see really quite a stable situation. As you were saying, the whole transformation is happening on the risk-free rate rather than on the spread among countries. And that's a remarkable achievement in terms of policies coming up, but it's something that still leaves open the door to potential additional repricing coming forward. In terms of lending condition, what we see is lending rate starting to tighten. We see the tightening of the supply condition, and we see at the ECB level, at the euro area level, contraction in demand both for residential and investment activities. Particularly investment is important because it's really signaling some weaknesses on that side. If we look and we do at the EIB something similar to the bank lending survey of the ECB, but we focus on Central Eastern Europe in particular, there we see that the supply conditions were tightening much earlier than in the euro area, also because the national central bank were tightening earlier. But also what you see is that the demand side remains more muted, while on the supply side, banks started to have a much more concern on NPL. And I think the NPL story is something that is still there with a little bit of unknown. And I come back to what I was saying at the very beginning, the very strong policy support that was coming during the pandemic and with the energy crisis is still supporting the corporate sector, together with the capacity to reprice. So the profit margin of corporate is quite good, and the financial situation of companies was relatively good, but you don't really know where it comes from. If only comes from the policy support, then going forward, you may see less of this and you may see more NPL coming up. And you still don't have the real picture on the asset quality side of what's coming up. And if I go to the last point, really potential growth, it means potential growth on the one side and transformation of the economy, particularly the digital and green. It means we need investment, and investment come on two sides, public sector and private sector. Public sector, positive news, still the deployment of recovery and resilience facility, and I go back to Mario. On the other side, we know that the exemption on the fiscal side will not stay there forever. And we know that even in the reform of the fiscal governance, there are some clauses for delaying the adjustment process for countries, that should protect somehow investment, but the protection is mild. So the concern is what will happen 2024, 2025 with public investment, and partly will continue to be protected by recovery and resilience facility if deployment of recovery and resilience facility goes on fast. But the risk of deprioritizing a public investment in the agenda of single governments is there. And on deployment of recovery and resilience facility, I think what we are concerned is that somehow there is some lack of skills and capacity to implement these big investment projects in many of the countries. It's supported very much by Mario and his team with the technical assistance coming, but the problem is really huge. So there is a lot to do in terms of reskilling for dealing with this big project. And on the private investment side, I think the combination is really how much the financing conditions will affect and interact also with uncertainty. Uncertainty is very much pushing down investment, and we see in all possible ways. So this is a combination of uncertainty pushing down and a tightening condition may again bring to concern for private investment. And if you look at the German data, real investment, it's really low. What's happening there? I think it's a combination of all these factors and the big uncertainty parts.
So you set out a huge challenge, and it was actually a very good summary of looking at it from the public and also from the markets and also from the private. So William, I'm going to come to you and pick out on some of those themes and ask if you feel that that there is that scope for repricing and how the private sector is engaging with the public sector. There's a lot to unpack there for sure, but it'll be interesting to see. And also in the framework of, actually what I wanted to ask as well is talking around the European response to the US IRA. So there's that element here too, and how when you're looking at the future of the investment gap and you're looking at how you're working with within this macroeconomic environment, what is your thoughts on the US, and how is your thinking around both bringing in the IRA but also the geopolitical element of the US in the concerns that you have?
You raise a number of very important points. So on the repricing, based on history, you would expect that if you have a real big growth scare, you would have repricing. It has always been like that. You would expect that the same behavior applies. For the time being, we haven't really seen it because apparently there is not yet the growth scare. And I think this is still related to the idea that we're coming out of if you think of risky assets, out of a challenging environment last year when the risk-free rate was going up, and this had an impact on equity prices, temporarily had an impact on corporate bond spreads. It has been very easily taken on board, as you mentioned, by sovereign threats. TPI probably has played a small role, but I think also in an environment where you're still in recovery mode, why would you become obsessed about the credit quality of one or another sovereign in the euro area? So it just tell me what the growth outlook will be at some point, and then I will tell you what the pricing is. So we'll see. Eventually, you would expect that fears about cash flows going down will come back to dominate, at least for a couple of months. And then everybody will price the recovery and the interest rate cuts next year. So that's point number one. Point number two, on US, the IRA and the European reaction. I think in terms of fiscal tax competition, the saying is it's a race to the bottom. And then you could argue that IRA is perhaps the race in the other direction. So then, of course, well, to state the obvious, we just must make sure that we have a European answer to that, and that it's coordinated across countries, and that there is, I would say, well, as a European citizen, I would go for a European approach, because some countries do not have the leeway, sadly, that they should have in coping with US initiative. I think it's also going to be very interesting in the run-up to the presidential elections next year, how IRA will be handled, and whether it will be an element of the debate, because it could be tempting, depending on who wins the elections, to kind of redeploy the money in another way. You could imagine that there would be preference, for instance, for cutting taxes rather than continuing to roll out the IRA. So that's another element that we need to keep in mind. And then, yeah, on I think your last point was on the geopolitics and the decoupling and things like that. When I speak to corporate clients, well, they listen very carefully. At the same time, I have the impression that it's a very gradual process. If you think about deglobalization, which actually is too strong a word, I would say. We have to find something else. In the most neutral way, it is actually boosting the resilience of supply chain. Now, that is going to be a very long process. If you're a vertically integrated company, I think it's easier to do. If you're not vertically integrated, try to find supply that is available, very important, that is available closer to home. I mean, that's a challenge. So it's now you could also argue that it is something that will bring positive capital expenditure dynamics closer to Europe, for instance, and and that, relatively speaking, is good at a global level. I mean, yeah, you could argue you do less say in China, you do more closer to Europe, or you do more in Vietnam and India, like has been mentioned earlier in this conference.
Thank you very much. Thank you for putting those three real key areas into those buckets as well. Andrew, well done for using Slido. Your excellent question was actually something I was going to pick up with Pedro as well, because I did say that we would come back to this. So how are the demographic shifts we're seeing, particularly regarding aging population, going to impact the European economy's ability to grow? So it's going back, and if you're looking at this is what the growth target is, this is what the growth outlook is, there is this real key issues around the demographic shifts and the real structural problems that Europe is facing. So Pedro, over to you. I think that you wanted to pick up on this because it is such a key important point.
Yeah. Okay, thank you very much for the question. I will not limit my answer to aging,
no, I think
but just to, go to the question directly. Labor force growth is projected to decline, as always, in Europe, like something like minus 0.5 over the next decade or so, whereas in the US is projected to grow by around the same, but in the positive side, so plus 0.5. As Mario have a code FT, I will do it myself as well. The FT last week revealed that rating agencies warned of possible downgrades if costs of aging are not tackled properly. And of course, this comes for three dimensions: impacts of aging on growth, which I just mentioned, deep in public finance from rising healthcare and pension bills, and the rising borrowing costs that could result from that. So on that, of course, we rely on the work that is being done by governments to address this issue. What I'd like to probably highlight here is that the economy is facing a simultaneous number of changes, what I will call global trends, that will affect very asymmetrically economic agents, economic sectors, and possibly countries themselves. And I just mentioned some of them. So on the supply side, we have all the developments of automation, artificial intelligence, the possibilities opened by remote working, of course, the climate transition, and the aging itself. All those trends will affect very asymmetrically economic agents, economic sectors, and possibly countries. And on the demand side, we have the digitalization, which of course increased considerably over the pandemic. We have a shift in economic power. I mean, the market share of Europe is shrinking at global level. The growth comes from Asia, and the large populated countries are there. And we have as well this globalization, or the lack of a continuation of globalization and geopolitical changes. So what this means is that possibly in the future we'll not have any unexpected strong growth, but what we'll have is a lot of asymmetric impacts across, I say again, agents and sectors, and that's very important, of course, for investors. So how this should be dealt with, and now I will mention three stylized facts on risk sharing in the euro area. The first one is that, I mean, at least compared with the US, there is a limited degree of risk sharing in Europe. So that's the first one. The second one is that, I mean, there has not been obvious progress in financial integration according to the indicators of the ECB and the association itself since the period before the great financial crisis. And third, financial integration was not resilience to financial adverse shocks. I'm referring, of course, to double-dip recession in Europe, but was resilient to the COVID shock. So how could we should increase this resilience? And basically there are three channels: the fiscal channel, the banking or the credit channel, and the capital channel. So on the fiscal channel, I see room for a fiscal capacity or a macro stabilization function within the euro area. And of course, that could bring some additional possibility for risk sharing. But I would say that on the financial sectors, the effects could be stronger. On the credit or banking channel, every time I go to the US, I am asked why there is not a deposit guarantee scheme at the EU level, and it's something that is difficult to answer. I will just remind very briefly the advantage of an European deposit guarantee scheme, which is level playing field across banks, mitigate risk competitive distortions, being a line of defense in moments of financial stress. And finally, and not so obvious, it will also align control with liability. So control is decided at euro area level, whereas liability is taken at the national level. So that would be my suggestion for the banking or credit channel. And finally, on the capital channel, we mentioned this morning, to complete the capital markets union, Mr. De Guindos made some suggestions on that. I will put forward some on my, which are well known by everyone, but some suggestions. So it's, I think, very important to have a larger participation at retail level. And for that, pan-European insurance products or pension products, I think, will help very much. We are moving to a digital, we are now in a digital context. So I think disclosures should adapt to this digital environment. And of course, we have to improve financial literacy, and many countries and supervisors and governments are doing a lot of that, and it's important that that shows on the results of behavioral finance. And as Mr. Guindos mentioned, supervisory conversion is extremely important. We have, I think, a very good experience on the banking sector. Of course, there has been some progress on supervisory conversion on both pension and insurance, but as well on markets. But I think that's very important. And more important than supervisory conversion should be enforcement itself. I left some suggestions for the regulatory agenda, but I'll stop here.
Thank you very much. We've got around 12 minutes left. So we've got one question still to come from Saida. I'm going to pause it for a minute, partly a little bit because I think that could be a whole session in itself. It's up there. So we will get to it. But first of all, I actually wanted to ask Mario a question that Deborah picked up on, and something that we've heard as well. When I was in Rome not that long ago, we were talking around the Next Gen EU and the transmission of the Next Gen EU funds into Rome. And one of the key questions that came up was constantly that actually the projects aren't there, the financing is there, there is a real, and actually this linked to the climate crisis as well. The financing is there, especially for transition infrastructure projects, but the projects and the skills aren't necessarily complementary to that. So is that a concern that you are having, and how does Europe address that? I think it ties in incredibly to this also, this integration, and actually how are we upskilling, how are we looking at projects that will enable us to ensure this climate crisis is addressed effectively and the transmission of the Next Gen EU is used at its highest level?
Well, definitely. Next Generation EU and the RRF, the centerpiece of that is reforms and ability to do reforms. So it works as long as the public administration at all levels say state, regional, local, takes up the challenge of being a good project manager. This is very clear. This is the axiom on which the Next Generation EU is based, on which the RRF is based. And that's, I think, a response to an excellent point that Pedro raised, the one of counter-cyclicality. Because let us be very, very clear. The reason why we have the Next Generation EU is because we wanted to be absolutely counter-cyclical, where the cyclicality was the deglobalization, or call it as you want, William, but to be clear among us, was the deglobalization. We tried to be counter-cyclical and to construct endogenous demand and endogenous supply in Europe or there around. And that's what the Next Generation EU is. That is the pact. Countries make reform, they become a credible demand and supply part of the European thing, and that's the flexibility in the part. But of course, the centerpiece is this project management ability, and after management, of course, project implementation. I think that's one of the reasons why my DG exists, DG Reform exists, exactly to support member states into that. The challenge is much bigger than us, there is no doubt, but one of the reasons why we do is that it's not only about doing a project, it's about trickling down the capacity building. So we don't only want to do a project, but we want to make sure that the ability to do it percolates down. And actually, you know, today as we speak, as we know, in Brussels, there is a competitiveness meeting of the ministers. The Minister of Competitiveness meet in Brussels. They discuss very important things, but they also celebrate the 30 years of the single market, which is today. And it's a bit ironic because, as you know, the single market was pushed by Margaret Thatcher and Lord Cockfield, and the only serious fragmentation has been when the UK decided to move out. But the rest of the single market increased in integration. I mean, there may be areas where we do not have as much integration as we wish, and capital is one, and maybe some infrastructure is another. We have some infrastructure, good trains from Paris to Brussels to London, but maybe not so much in the rest. So there are parts where integration is not good, but we did not have episodes of disintegration. That is very important. So never having an episode of disintegration, this gives a huge strength. And that's why, to my friend Debora, who says 1% is optimistic, maybe downplays uncertainty. I think what it does is it does not downplay uncertainties, but it gives a right assessment to the ability to face uncertainties. And that's exactly the point. I mean, and of course, when we talk on finance, we remember 10 years ago, the big word was a redenomination risk and things of that kind. Nothing of that happened. Never we had an episode of disintegration. So what we are talking about is increasing integration of the single market. But till now, maybe slowly, maybe with some prolonged stops that we need to improve. But the direction has been one and one only.
Thank you very much. Giovanni, I'm going to come to you to ask around when you're looking at the risks. We have a lot of, it touched on the dinner conversation we're having yesterday as well, is that we've talked a lot about climate risk over the last 10, 20 years. We have a lot of, constantly we are saying we don't have enough data, and I completely reflect that. We obviously do not have enough data there, but we do have some, and we are aware of the climate risk. So sort of the known unknown, how comfortable are we that actually that we have the policies in place, or we're going into that right direction for when you're looking at the risk analysis of climate?
There are two aspects for when looking at the climate and the effect of climate on macro as a way to prevent crisis, which is much of our work. The first one is the policies and really how we finance the effort to get there. So now we have a situation in which we have policies and targets set at the EU level, and the financing that is shared through the NGU, and this is important. This is very important. This this sharing of responsibilities given a dividend. That is really this initiation of the virtuous circle I was mentioning before. You don't have the risk component that is driving volatility. You don't have the integration, the perception of markets improves, and this initiates a whole thing. So the important is to preserve this aspect going forward. So that there is an alignment between the target setting and the financing. Is going to be difficult, it's going to be complex, but it's been discussed by policymakers at this time, and this is extremely important. The other part is what you were mentioning at the beginning, the lack of data. It is true, but it's not just the lack of data. What we need to understand is what are the responses to climate events. Okay, it's not just the drought or the flood. This is, of course, very important, but how companies will respond to floods, risk, to drought, how individuals, how households will respond to all these big structural changes that will that are affecting now our continent as we speak. So that is still to be seen. What is critical now is really the fact that we are facing a series of shocks. That is the big change. It's not more one flood and then that's it for some time, but it's a series of floods. It's not one summer, but it's a drought period that continue and persist over time. The way to prevent this is really to provide insurance. It's important. I would like to bring really the example of the Spanish government that really set up this fund to provide insurance for the risks that are not, for which the insurance sector by itself is not able and then not willing to insure. So it's creating really a kind of deposit insurance fund in a sense, but for climate risk elements. This is the way to go for addressing the uncertainty, for addressing the persistence. We need to create some sort of backstop that is incentive compatible, that is there to really stop the buck, really give the impression that, okay, there is some coverage, some insurance at a certain point. If this combines with the elements that I was saying before, so alignment between policy targets and financing, then I think we have a good mix for a challenge that is, let's say very bluntly, enormous for us and for the next generation.
It sounds like, in theory, a pretty straightforward, very sensible solution and framework. I think the reality is always going to be a little trickier. Debora, I'm going to ask you to say the last words. I have 1 minute 43 seconds here. We're okay on time, so I'm going to take a couple more minutes for Debora as well, just to talk around that reality. We've heard the policy response. We understand that the backstop would be incredibly important if you're looking at the insurance, but when we're looking at the investment into climate response, how are you seeing as the EIB the reality for that huge investment gap?
I think so when we talk about the impact of the climate transition and advancing in the adaptation of the economy to the net zero transition, I think the point of investment, we need to transform the economy and we need to invest. And the point that I see are the two sides. On the one side, you have the physical risk. You will have a much more frequency of event and much more damage. So one part is for sure the insurance, and I think that's very good, but you also have to anticipate the damage. You have to have a lot of adaptation investment, and actually at the European level, we are not that good in that. There is not that much adaptation investment coming up, and there it requires not only the financing, but really a change in culture and bring adaptation on top of every single project that is being done, and not only done by the public sector, also the private sector has to start thinking about adaptation. That is something not so common. It's considered to be a public good that the public sector has to produce, but actually there is also a very strong rule on the adaptation side on the private sector. And I think there it's a lot of information as well, and then everything that comes and all the financing, etc. But also widespreading the need of this transformation, and kind of it becomes easy because events come more often, and then people that have experienced damage, they actually are more prone to invest. And we see it very granular with data that actually the very strong predictor, both for the municipality side and for corporate side, of engaging in adaptation investment is having had losses due to climate events. So you learn from that. But then there is the second part, and it's the transformation of our economies. And here, I think we have to distinguish between the buckets of sectors of the economy. You have the hard to abate industries that are those that are very much polluting, if you want, but that you are not sure about which technology will make them viable in the long term. And there, the discussion is very difficult, how you manage those. There is a lot on investing in new technologies, and that's a part of the challenge, but also some are very, very traditional backlayed industries. And there, the transformation is really coming from policy, regulation, and providing incentive, but a lot of support to innovation has to come. And then you have, if you go down, you have the very good green part of the economy. That's see the transition as an opportunity. You can further incentivize that, but they are fine. They are seeing the potential going forward. And then you see in between, and in between there are industries and sectors where some of them understand the transformation challenges, some are still thinking what it really means for them. And then the policy certainty is very, very important. So if you have doubt on the transition, on the path, on the timing for the transition, etc., you will maybe do something, maybe delay, it become like a not a necessary investment. And that's where it's so important that the policy framework in Europe is going so fast and so direct in terms of the transition. And it's coming from the regulatory side, from the Commission regulatory side, but also on the financial market side. And on the financial market side, I think what is very interesting is the fact that it started with the ECB rule in terms of supervisors to assess the exposure of banks to climate risk, then quantify what it means. And the more it becomes concrete, it will be pricing climate risk exposure. And when it becomes pricing climate risk exposure, then it will really motivate again transformation. And I think the picture is coming, the piece of the puzzle are coming together, and we will see much more. And it's coming from this change of the overall environment, regulatory supervision and awareness coming together.
Thank you very much. And we are coming to the close of the first block. We will have refreshments just outside in the lobby over there, and then we will be reconvening at 10 a.m. where we'll have a presentation by the ECB on the state of European financial integration. So we've had a lot of discussions around where policy needs to integrate, what for the policy response for the huge challenges, especially looking at the geopolitical risks of deglobalization, of the future for the US, of rising inflation mixed with interest rate hikes. And also, we didn't get into it, but there are conversations around QT. We slightly touched on it, but there's a very different rate environment that we are operating in both financial markets, but also the real economy and investing. And then we obviously have the future challenges as well. So we will be today very pleased in going into, once we've looked at the state of European integration, we will then talk around the technological innovations. And then we will be going into, again, circling back to the climate funding, and also how integration in Europe can step up to this huge challenge. so peppered with all these conversations around how the CMU, the banking union, and how Europe can integrate as well. So I want to thank my panelists for setting out this macro overview. It's been very broad, so thank you for keeping with us and also hopefully covering a lot of topics that we'll delve into deeper throughout the day. So well-earned cup of coffee outside. I want to please join me in thanking the panelists. So thank you.